Slowdown. Welcome to the CNBC TV 18 special. I'm Shereen, Bhan, and we're in conversation with a man who's been tracking India for long, but he also tracks what's happening with global growth and the global economy. Brian Moynihan, always a pleasure. Many thanks for joining us here on CNBC TV 18. Good to have you back on the program. Let me start by talking to you about global growth. There are worrying signals that have come in from the jobs data for the month of February. Is that an aberration, or is that a sign of further deceleration as far as the economy is concerned? Let me start by asking you about that.
Sure. Well, it's wonderful to be here again, Shereen. I think we have to back up a little bit and give the context. Last year the global economies grew faster in 18 than they did in 17. They moved up to 3.8 in the world and around 3% in the U.S. The prediction now is for that to slow down to the low threes in the world, and the U.S. to slow down to 2 or so. Our experts, our research team. So the slowing down always has people much more concerned, and why? Because it's not going up. But the reality is the growth is predicted to be as solid as it's been for most of the years since the recovery. And as you look in the numbers, even though you have a jobs number, it might look odd here, a consumer spending number in December where people worried about. What happens is the subsequent months show this sort of underlying U.S. economy is pretty solid right now. And we see that in our customer data. We see that in enthusiasm.
Yeah, you had a record quarter.
Yep. Yes, the fourth quarter was a record quarter last year. $28 billion by driving responsible growth in our company.
Let me just stick with the U.S. for a little bit, because as you pointed out, that forget the Feb jobs number, 20,000 versus the estimate of 180,000, and that could perhaps be an aberration because wage growth continues to look strong, the best that we've seen since 2009. The unemployment number is back below 4%. So on balance, given the indications that you're picking up from consumer spending and from your SMB clients, you believe that we're unlikely to sort of fall off the cliff when it comes to growth?
Yeah, I think so. If you start from what we see in all the different things you just talked about, in the end of the day, the U.S. economy is 2/3 what people do. And the U.S. consumers are good at spending. They've been that good. Their debt is in good shape. In other words, they haven't overborrowed. The housing market continues to rise in price. Credit is available in the housing market. And so if you think about all that, what we see is a consumer spending from 16, 17, 18 went from 3% to 6% to 9%. And when I talk about spending, I mean all the money that moves in our franchise, which is about 15% of the U.S. economy. You see it going on. When you think about so far in 19, what you've seen that is like 4 to 5%. So it's slowed down a little bit, but stronger than it was in 16 and the years before that. So you had an acceleration, which is turning over a little bit. And so if you think about car sales, you think about home starts, you think about all these things, they're all fine because, back to your basic point, people are employed, they're getting paid more, the business confidence is high, not as high as it was, they came down a little bit, still high, the consumer confidence is high, all that is good. And so we don't see that breaking right now. That doesn't mean there's lots of fun things to talk about in terms of uncertainty and stuff, but when you really look at it, you see the consumers are spending. If 2/3 of the U.S. economy is in good shape, the U.S. economy is in good shape.
I'll talk about the uncertainties in just a second, but I want to talk about what you believe is the course now as far as the Fed is concerned. Sure. Do you believe that the patient approach adopted by the Fed is likely to continue through 2019, especially in light of what we've seen from the ECB and the growth signals that are coming in from that part of the world? Yeah,
I think you need to sort out the Europe from the rest of the world right now, and we'll come if you want to come back to that. But in the U.S., the Fed had said that when they got to a range of 2.5% to 3.5%, that was the so-called neutral range, or they don't like to use that word sometimes, but basically that's what they mean. The idea is they'd stop and make sure that the data proved that they needed to continue to take the accommodation out. There's no signs of inflation. Wages are growing a little faster than people thought, and that'll be an interesting question down the road, but you're talking about relative differences are small. So I think the Fed did exactly what they said, which is to bring, once they got to the range, they were going to stop and take a picture every meeting, and as the data comes out, to make a decision. The overall interest rate structure is still very accommodative to growth. The Fed funds rate being at 2.5% target rate is as low as it's ever been, except for the period since the crisis. So if you go back and look at history, this is a very low interest rate structure. Mortgage debt, the 10-year to 2.70 or something like that, 2.7%. Those are levels that are as low as I've seen in my business career, and most of us will see in our business careers. So it's still solidly accommodative. It's just they had to remove some for fear of overheating, and they told people they were going to do it, and they did it. But I think people got crossed up thinking there was a change in policy. And if you actually think about it, even going back to Chairman Bernanke to Chairman Yellen, it's been pretty consistent. Let's get the accommodation out when the economy can do it, and then let's pay attention meeting to meeting, and let's pay attention to our two mandates. Keep the inflation, watch inflation and unemployment's very good, and inflation is kind of okay.
So what do you expect then for the Fed in light of what you've just pointed out for us, the picture that you've painted, in terms of action for 2019?
I think there's lots of predictions about where they might go. I think the analogy that was told to me by a person that used to be on that board was, think about a mountain climber. They're now going handhold to handhold. They're not thinking about a path. They're not thinking, they have a place where they think rate structure should be. So I think we think the economy is strong enough that we think you could see rates increase. The Fed raise rates later on this year, early next year. Other people think they could come down. But the reality is we won't know till we see how the economy plays out this year. But overall, the accommodation has been removed a bit, but it's a very structurally sound for good business growth in the U.S.
Okay, let's talk about, you said let's separate Europe from what's happening in the U.S. What did you make of the comments that have come in from the ECB, and as well as the fact that they continue with stimulus measures and new measures that have been announced?
Well, I think, they're in Europe, the issue is Brexit makes all things different. And leave aside the actual activity within Brexit. Here we are a couple weeks into March, and we still don't know what the answer is. But
is it really that big of a deal for the rest of the world?
Well, for the rest of the world, that's a different question. The China slowdown impact on Europe is higher than it is the U.S., for example. And so I think it's a combination of things. And so I think the ECB is clear in what they're doing. Is they're a little worried that the growth slowed back down as all the economy is tipping over. But the good news is Europe's still predicted to be positive, which has not been the case in a lot of years. You're seeing the restructuring of economies underneath it take place and recoveries take place. But the reality is, as a slowdown came, they had to, just like the opposite of the U.S., they had to make sure that the accommodation was really there to keep it from going negative and keep the thing pushing forward. And I think they were clear with that. But I think the uncertainty of China and Brexit adds a different element to them than it does in the U.S. or maybe the economies in this part of the world.
You brought up China, so let's talk about China and the fear or the possibility of a trade recession, especially if you see the numbers that are coming in from China at this point in time and the impact that will have on global growth. Is this the number one concern for the markets?
Well, I think there's two elements to it. One is what's going on with the growth rate, and our prediction in China is 6.2% for 19 in GDP growth. So, it's consistent with what it's been in the past. But I think as a government in the policies to fix the credit issues and the overborrowing and things like that, that has a slowing down effect on the economy. And I think they're willing to make that trade-off to get the economy more and more structurally sound. And that's what's been going on. When you think about the trade question, the administration in the U.S. has been clear. We want a reciprocal. We want open access to markets, intellectual property, and things like that. It sounds like they're getting close to the deal. I have no special insight. That would be good for the world because you can't have the two biggest economies in the world sort of, at loggerheads with each other. You need to get by that period, and that will calm the world down because the amount of dependence on both import and export from China, U.S., and the investment coming from both countries would be better settled if it settles down, and hopefully that'll happen in the next few weeks is what they keep telling us.
That is what they keep telling us, and the hope is that it will happen. But, since we're talking about trade, and I want to get your comments on what we're seeing happen between India and the U.S. I mean, nowhere in comparison to what we're seeing happen with U.S. and China. But President Trump keeps bringing back the tariff issue, even in the context of India. The U.S. has just withdrawn the GSP benefits, and India's position has been absolutely clear that, look, we're open for business. Don't link the GSP benefits to what is happening with market access, and that's not a fair thing to do. What do you make of this sort of blow-hot, blow-cold relationship that India and the U.S. seem to enjoy currently, especially when it comes to trade?
I think the two countries have a great relationship, and they've worked together for years, and I think I'm from a big family, and sometimes, the brothers and sisters get in a little bit of a dispute with each other. But
sibling rivalry, is
it? I think it's really, you got to come back to reciprocity. The words have changed over time. but reciprocity. In other words, fair access, open access, and there's a pretty good open access in India, and the current administration's even opened up more in terms of ownership of insurance companies going up higher and things. But that idea of being able to do business on equivalent terms for these large economies is important, and that is really, if you listen to the
is it a perception issue when it comes to India? Because as you pointed out, I mean, you know, I don't know a single sector where foreign ownership is not allowed, even to the tune of 100%, even in very sensitive areas. So is there a perception issue that India is denying market access?
I don't.
Or that the tariffs are discriminatory?
I think whenever you have tariffs, that feels protectionist. That feels like it's not open. And so I think it's, whether it's perception or reality, is the end of the day, I think what the administration has used is the trade imbalances and the tariffs as ways to get people's attention on open access. And I think these two countries can figure this out relatively quickly. China's a little more complex because the size of the movement's higher and the different things that move. Here, I think if the Indian government continues to provide open access and stuff, I'm sure things will work through. These two countries have a strategic relationship among all dimensions that's very important, including the Obama administration, the prior administration coming and visiting here, and the amount of work that goes on. So I wouldn't be too worried about the relationship between these two countries, but I think the clear stand by our administration, all this is reciprocity and open access. And so when people thought it was anti-trade, it's not. It was trade on fair terms, whether it's Canada and Mexico, whether it's China, whether it will be Europe, or whether it would be here. And so I think if governments work together to have that open access, I think it'll all work through.
Since we're talking about India, let me ask you about your view on the Indian economy. I mean, it continues to be one of the world's fastest growing large economies today, especially since we've seen the slowdown in China. You've been bullish on India. Of course, currently a disproportionate amount of time and attention being spent on the outcome of the Indian elections. Is that a consideration that you're looking at?
Well, the business community doesn't like uncertainty, and no matter how it comes up, whether it's trade debates, whether it's Brexit, whether it's elections, politics, whatever it is. Yeah. They want to be able, because you're investing across multiple years. So whenever I've been CEO, this is my 10th year.
Yes.
So I've gone through the two presidents of the United States, I think 3 French prime ministers, 3 British prime ministers, 2 people in this country. So you go through companies, and I'm one CEO, and so companies tend to have a long duration thinking, and anything that gets in the way that tends to make them think what's going on. And so you have election coming up here, and people want to know that the policies will continue, and therefore they can continue to drive it. If you back up, we have this economy at Bank of America Merrill Lynch, which is the best research firm in the world, has it growing at 7.2, I think, this year, and GDP in 19. That is the fastest growing larger economy, not one of the fastest growing. And I think if the country can get through the elections and the outcome says the policies of openness and reciprocity and things like that are there, I think the world thinks this economy is very interesting to them. And when you're at Davos and places like that, everybody's saying, how can I get into keep developing this market? And you have a tremendous entrepreneurial segment in this market. So I think all those are good things.
Let me pick up on some of the specifics that you talked about in India. What interests foreign investors today about the India story? I mean, there's the whole infrastructure piece, which traditionally has been a difficult area to play out in India. There's the whole services economy. There's the manufacturing side of the story. When you talk to investors, what are they most bullish about? What are they most convinced about? And where do they intend to continue to put their money?
Well, if you think, there's a couple ways to think about it. As a domestic economy, 1 billion plus people, spending and consuming more. There's tremendous view that can go on, and you're seeing companies invest in the retail segments and expand in retail segments. If you think about the power segment, we've done solar power financing here of major installations, and the ability to bring the power on, especially on a green basis, a new power basis across this country. Take the medical side. You think about the amount of medical care. The government's building more hospitals, the amount of work that goes behind it, the amount of machines that go behind it, and things like that. And so all those are there. And then you think about the other way. We have 20,000 teammates that work in this country today and have worked here for us for 20 years in this country or more, that provide great services to our worldwide platform at technology development, operations and processing. So you have a tremendously, if you think about the other way, you have a tremendously talented group of people who have a tremendous ability to retool. We've been able to get, and they talk about reskilling around the world, we've been able to take programming which was of one stage and move it to the more modern types of code programming and stuff by retraining people over 6 months in our groups, by taking them offline and retraining. That kind of enthusiasm to just learn and drive is tremendous. So you have a tremendous talent base, schools expanding and all that, with a tremendous domestic economy. Those are interesting places to be.